So this is Markets with Mike. We have behind us, behind the great big blue First Option Bank curtain, we have Chris Toman, who's there to take questions. Our technical person is our marketing guy, marketing lady, Mallory Vaughn, who's helping us get through this experience for the first time. And I think we'll go ahead and start. Chris, is that okay? We'll start with the market, what's happened. And I hear a lot in the news, people say it's unprecedented. Actually, what's unprecedented is the reason for the market decline, not the market decline itself. Chris is going to pull up our Dow Jones COVID chart that shows what's happened since the first of the year. And you can see a couple lines here. We'll explain what they are. The blue lines are the daily movement of the Dow Jones Industrial Average. And then the red line is the 7-day moving average. The green line is the 14-day moving average. And you can see that we had a dip, and that dip down at the bottom is about March 23rd or so. That was probably what the bottom of the market is. In a second, we'll talk about the upward trend since then. So you can see a really nice illustration that shows, number one, how quickly that happened, and number two, that we did have a pretty big jump out of the bottom right there, March 24, 25, 26. And we don't hear much about that on the news. We just hear about how bad it's been. But for us, we're more of a stand back and look at the whole scene type of thing. And Chris, if you go to the next slide, please. This next one shows the events that have happened. The events, Chris. There we go. This is events going back to 1940. And the interesting part about this is it shows the major event on the left, and then the date, which we've identified as the low at that point. And obviously, at this point, we think the low was Tuesday, March 24th on the COVID. It shows the drop that day, and in the COVID case, we're showing the drop since the high, which was on February the 23rd. And then it shows where the market was 20 days later. So you can see that 20 days after that low on March 24th, we're actually up quite a bit. And then it shows where we were 250 days later. And that's pretty reasonable. And if you look down that list since 1940, you can see that on 4 of those events, on 4 of them, the market was down further. On all the other events, it was actually increased. On 6 of them, 6 months later, 250 days later, the market was up more than 20%. So our point here is that we've been through these types of things before. We tend to recover. It's a pretty solid economy. It's a pretty solid country. We tend to evolve. The difference here, as Jerome Powell said last night, and Jerome Powell is the chairman of the Federal Open Market Committee, he made a statement that we can't predict the recovery at this point because we don't know anything about this COVID virus. We don't know enough about it. It's the big unknown. So whereas in the past, we've always been able to say, well, we think we're going to see this kind of recovery or that kind of recovery, or it'll take this long. In this case, our variable that's unknown is the virus. Will it come back? And if it does, how severe it will be, and what our reactions are going to have to be to it. A couple of, about the middle of April, we were able to listen in on a conference call with Ben Bernanke, and he predicted that the recovery would be more of a W shape. And Chris, if you could put that, there you go. This shows the different types of recoveries. You have an L recovery, a V recovery, and a W recovery. The L recovery is the red line where it goes down and then makes a gradual recovery back to where it was. We're not really seeing that. A V recovery is the blue line where it goes down and then goes back up at relatively the same rate, kind of like a pool ball going off of a bumper. The W recovery is what Ben Bernanke is referring to, and that's kind of what we think we're going to see, where we have a recovery, but then we have a second dip that occurs later. And we're looking at this dip sometime around July or August. That dip will be caused by a couple of things, but primarily when we start going back to being social again, we'll see the virus come back a little bit. And that may not take place until later in the year, but we think it'll probably take place. And so we'll see this W recovery. And what that tells you, what that tells us, is it's not a time to let go of being cautious yet. So we're still being cautious in what we do, how we manage our assets, and where we go from here. Which leads me to a point. This broadcast is not intended to solicit any buys or sells of securities at all. We just want to talk about the market. So if you have questions that involve the market in general, we'll be happy to answer them. and send those on in. So Chris, if you'd go to the Treasury, please. This is a tracking of the Treasury, the 2-year and the 10-year. And what you'll see is, what we kind of like to see is a little bit of a spread between the 2-year Treasury and the 10-year Treasury. And what should be happen is investors should be rewarded to leave their money in for longer periods of time. When the blue line and the red line start to merge, the red line is the 10-year Treasury, the blue is the 2. When those start to get closer together, we have some economic stress going on. That means that you're not being rewarded anymore for investing in 10 years than you were for 2. And that's when you have what's called an inverted yield curve. So you can see back in the later part of the year, we did right there have an inverted yield curve. It was very temporary, where the 10-year Treasury was actually producing less yield than the 2-year. And that was a little bit of concern. We like that spread to be a nice, solid, wide point, as you see right there over on the far right. And as you see back there in 2018, those are nice, comfortable spreads. And so we can see that an investor going with a 2-year Treasury gets rewarded, but one that's willing to go for a 10-year Treasury gets rewarded a little bit more. And that's the thing we like to see in a strong, healthy economy. We like to see that. Right now, if you look down on the right-hand side, you'll see we have that spread. It's nice and comfortable. There's a good distance between the two. However, our problem is that we're down pretty low. So you're not getting rewarded much at all when you're dealing with a 0.5–0.6% on investing for 10 years. So we're a little concerned about that going forward. All in all, our opinion is the markets are strong, the economy will grow. And Chris, if you go to that long chart now, that would be great. So we want to step back and look at the economy a little bit further out. So instead of looking at just what's happening today or what's happened in the last 3 months, it helps us to take back and step back and look at the economy as far as it's done in the long term. And in the long term, we could draw a line from the far left to the upper right and see that overall, it's like a little boy standing on an escalator with a yo-yo. The yo-yo is going up and down, but his feet are constantly going up on average. And at the end of the day, they both end up at the top of the escalator. There's some ups and downs as we go. We're seeing that, and it's not unexpected. In March of 2009, if you look back there, you'll see that the market was at about 60, the Dow Jones was at about 6,700. So we like to say that in about 10 years, you should double your money. We've actually gone from 6,700 back to the peak where we hit 28,000 in a matter of about 10 years, which is pretty incredible growth. So the decline we've seen over the last couple of months wasn't unexpected. The reason for it was a little unexpected. But still, all in all, while it's been difficult, we have a comfortable feeling that we're going to get past this. The markets will continue to evolve. And the truth is, the United States, what we do for jobs, what we do for how people make a living, that may change a little bit. But we've always adapted, and we probably always will. So those are all good things we like to see. Chris, do we have any questions? So there are 3 indices that we look at. We look at the Dow Jones Industrial Average, we look at the S&P 500, and we look at NASDAQ. The one that you always see is the Dow Jones Industrial Average. That's what you're looking at here. The other one is NASDAQ, and Chris will put that up, the long-term NASDAQ performance. And then the other one is the S&P 500. We tend to kind of use the S&P 500 as a benchmark. And the reason why is the S&P 500 is a more broad look at what's going on. The Dow Jones Industrial Average is 30 companies. They're all companies that you know, but it's only 30 companies as a sampling of the industries in America. The S&P 500 is what I like to use as a benchmark because it is 500 companies. It's more diversified and it's easier to look at. This is the, Chris, is this the S&P 500? Thank you. This is the S&P 500 over that long term, and you can see where it's had some dips and dives, and it's had some growth. It also has roughly long term, if you look back, you've got a far left-hand side where we were, upper right-hand side where we are, and it still has a nice solid growth. The long-term investor is rewarded. The short-term investor is probably not going to be rewarded if they jump in and out of the market every time it goes down. And we've seen a little bit of that, and it's going to happen. So I do have a question. I had a question emailed to me. When should you get back into the market? Somebody got out of the market in March, and they want to know when to get back in. That's a hard question to answer because I don't know what you were holding. His name's Russell. Russell, I don't know what you were holding when you got in, and I don't know what you were holding when you got out. But I do know that if you look at this is a great chart that Chris just put up. If you go back to about the 1st of March and you got out there, you're probably right now, you would have been exactly where you are. The problem is if you'd have gotten out more to the right, Chris, right about there, and panicked somewhere around the 3rd week of March, you sold out at a point that was very close to the bottom, and now you're trying to figure out when to get back in, and that's a little harder question to answer. And I think our answer would be, we want to talk to you about your risk tolerance, and if you're uncomfortable there, and we think there's going to be a W recovery, will you get uncomfortable again in July and sell it again? And that's probably not a good financial move because you're just kind of locking in your losses, but it's something we'd want to visit about. But if you try and get out when the market goes down, all you're really doing is confirming that you have a loss. And in the long term, the market's going to reward you for being there. So my intention here this morning was to give you an overall broad view of the market on where we are. We do use sources. Like I said, Ben Bernanke, we were in a conference call with him a couple weeks ago, which was really awesome. Together, Chris and I read 5, 6, 7 publications before 8 o'clock every morning. We're looking at research and trying to decide what we think is the right thing to do for our firm and to adapt our investment policy to our clients. And that's what we do. We don't react to these moves any more than we actually have to. And that's how we manage it. So going forward, our goal is to talk a little bit more about gross domestic product. We're obviously going to get into politics because that's kind of starting to get fun. We talk about what affects the market. We talk about economics. And any questions that you have, please send them in. We'll be happy to address them and make them part of our broadcast and get everybody in here so you can spend 15 minutes on Friday morning and learn something and make your day better. So have a great Memorial Day weekend. Stay safe. Have a good time. Stay socially distant. And we'll talk to you next Friday. Thanks for joining us. We appreciate it. Oh, we got a question. What do I anticipate going forward? I anticipate that in July, we will probably see a decline in the market. If we don't see a decline in July, we think we'll probably see it again in October, November. Having said that, I'm going to go back to what Jerome Powell said last night. And Jerome Powell's an extremely smart individual. And he said he can't really predict what's going to happen next because of the great unknown on the virus. So what we think we need to do is just keep our portfolio solid, pick good things. And if we think a company is good and it's still good and it's gone down in the market, there's no reason to sell it. The industries that we think are going to go up, there's industries we think to avoid, which might be a better part of the question. Right now, we're avoiding travel and leisure. That's going to take years to come back, if it comes back at all. The industries that'll be there always are healthcare. Some of the industries that we're looking at very closely are technology, especially things like Zoom. We're looking at, we're careful on restaurants, but there is a portion of the restaurant business that we're interested in, which is the delivery services and the packaging services. Those are interesting to us. And then financials are interesting to us. Technology is, if you look at the NASDAQ, technology is strong. It really depends on which technology you're going to go into. Technology has a lot of subsectors. That's very important to look at. Subsectors on technology are going to be off data storage, offsite storage, communication. Like I said, meetings, things like Zoom, things that people can use to do information. What we do think is going to change is you're going to see a lot of businesses change how they do business. You can have a lot of businesses that realize that they can have more people off site. They're still productive, and that's going to change how we work as a country. Unemployment. My dad used to say 5% of the people don't want to work anyway. Dad was probably right. If unemployment's 5%, you're probably really 100% employed. So right now we're working with what are truly unemployment levels that are higher than we've seen in decades. Where will those jobs go? Well, those jobs are going to change. Companies that are hiring right now are service companies. Walmarts are hiring, grocery stores are hiring. A lot of companies are hiring right now. They're just looking how their business model is changing. So the unemployment will start to come down. It's just going to change what sector people are in. And it's got to come down. Unemployment's got to be, like I said a second ago, 5% is about perfect. We were at 3% earlier this year. That's awesome. That's unprecedented. So it'll probably be 18 months before we're back below 9% again. It's going to be a tough road, and there's no doubt about it. It's going to be difficult for some sectors more than others. A lot of you out there, I can see names. I know what you do for a living. I know what sectors you're in, and some of you have probably adapted how you're doing your jobs. And the companies that can adapt are going to be the ones that are going to be survived, but they are going to have to adapt, and that's going to change unemployment a little bit. We got everything, Chris? So that's our 15 minutes. Again, thanks very much for joining us. We appreciate it. Look forward to seeing you next Friday. Thank you.